Okay, now let's talk about accumulation and distribution. These terms, accumulation and distribution, originally came about when discussing about the smart money and its condescending counterpart, which is the dump money in the market. Smart money investors were supposedly the bigger and better capitalized group with all the latest tools and data that they need in order to make some advanced decisions, right? Remember, these guys control a huge amount of money, so they need all the latest tools and data. So it makes sense to say that this is a group that we need to watch for clues when trying to determine the market direction, right? So history will actually show us that institutions are not necessarily the smart money, but the concept is still the same. So those with the best knowledge often buy in advance of prices trending higher, and they also are able to sell in advance of price trending lower. And that's obviously help them to secure some profits, right? So remember, you have to buy low and sell high. That's the only way you make profit in this market. The former is called accumulation because they accumulate shares of stocks in advance. Conversely, the latter is called the distribution. This is because they are distributing their shares to the latecomers, aka the retail traders, at the end of a rally or just before a decline in the market, right? So the latecomers who are buying at a higher price instead of buying at a lower price, or selling at a lower price instead of selling at a higher price, right? So they basically don't make the profits, right? Now the patterns in both trending markets and flat markets, and by flat market we're simply referring to a rangy market, those patterns that are formed depend heavily on price action, right? So in this case, the highs and lows are very crucial, and so are the relationships among the swings within. As these swing points form the various shapes we are so accustomed to, right? The shapes that we are so much used to. Now you have to keep the following statement in your mind at all times, right? So forcing a market into a buy or sell mode is a very, very big mistake. We don't lead the market, we only follow the market. So if patterns do not jump off the page or scream at you, then they are simply not there. Meaning to say the patterns must be clear. Fear not, as the market will tell you what it actually wants to do. But until that becomes the case, the best trade you can have is actually the one that you do not take. The market will always tell you what it is doing. The secret of technical analysis is to wait for the market to talk before trading and continue to listen in case it changes its mind. That's how you manage your trading once you're already in the trade. The market reveals many things as the data is being manipulated through various timeframes. Once the overall direction of the market can be found, a trading decision can be made in line with your own trading style. The secret is to let the market talk. Let the market talk first. So if you have difficulty finding trends, it is better not to trade than to force the trend lines and the patterns onto the chart. Remember, there's always another opportunity to take a trade, so don't fear losing out on a setup or on a trade. The market often does the opposite of what you would expect. Technical analysis is based on the premise that price patterns repeat themselves. This is because people in the markets repeat themselves, giving similar market conditions as they have done in the past. For example, when the trend is at its end, the hardest task is for an average investor to pick the tops and the bottoms. This cannot always be done. But what can be done is the use of technical tools to find reversal signals, trend line breaks, and penetrations of support and resistance levels. You will be wrong many times, and probably a lot more than you would care to be. Now, what do you do when you're actually wrong? Well, the secret is actually to deal with that properly, right? To deal with being wrong in a proper way. If you are wrong, admit it early. The market will not bail you out, okay? There's no discounts for you to get out, right? So it doesn't care about your emotions. The charts will tell you what the market is doing and give you signals as what to do next. The secret is not to anticipate the market, but prepare to act when the market tells you it is ready to go. Remember, don't lead the market, you follow the market. We don't lead the market, we only follow the market. A good trader in controlling their risk and position sizing, and by position sizing we're referring to lot sizes, right? So using the correct lot sizes according to your risk management, will rarely have to suffer through drawdowns that traders have during corrections. The greatest opportunity for retail traders and small investors is to let the big investors and the other market participants to place their orders first. Then we analyze what they're doing and follow along. So we trade with the big boys. That's the main skill that you should take out of this course. You don't have to predict the trend. You just have to find ways to ride the wave in the right direction that the big boys are going. It is said that over 90% active traders in the financial market don't make any money over the long term. There's a lot of confusion about the exact numbers to this, but it is safe to say it's difficult to be a profitable trader over time. Even investors have terrible timing on their buy and sell decisions. It all comes down to emotions. So majority of the errors that traders and investors make are emotionally based, and this is because they rely mostly on the internal signals. So let's jump into the next lesson, discuss what triggers these internal signals so that you can better understand how to avoid these signals when you start getting them yourself during your trading times. So let's get straight into that lesson.